Lots of people have seen the transports come down, particularly the trucking companies, thinking this has to be the chance. Why wait until the Fed is finished tightening? Oh, that is a very refreshing view. I've made that mistake many times in my career. Why is it a mistake? Because stocks react to number cuts. And every time the Fed raises, the number cuts will occur in all the freight companies. Now, you would only know this if you've traded multiple freight cycles like I've had. I think a stock like J.B. Hunt's terrific, but not this year. Maybe later, maybe at the beginning of 2023. Look, we at the Charitable Trust sold UPS. Why? Because when the Fed starts tightening, it's a very difficult stock to own. We made a lot of money for the trust. We hope we helped you in the CNBC Investing Club. But you know what? We don't like to take a beating when we've seen others take beatings before when they jump the gun on a freight cycle, when we have. Now, why do I, what is, you probably ask, is my frame of reference? Well, we're very close to Uber, particularly to Uber Freight, okay? And we had Leo Ron on recently, who runs Uber Freight, and he said the freight rates have dropped huge. 20%, 25, 30% in some cases, and that's in the spot market. The spot market is a very good prelude of what happens after long-term contracts roll over. How can I get into a business where I know better than anyone else, because I've got it from the source, that the spot rates are coming down and coming down aggressively? So here's my take. Don't be in a hurry. It could end up being a great investment, but being early makes it into a very bad trade.
So the question is, what if you own, let's say, a UPS, as Jim specifically singled out, or a FedEx? Karen, you own both. Does this concern you that the spot prices have come down?
Well, I actually think spot prices, I think pricing for FedEx and UPS have not come down the same way that trucking and rail have. So that's one thing. I do think, though, that the cyclicality of how these things trade, that's a real thing. Jim's particularly good at that. UPS, though, I feel like the valuation, it has not traded at a valuation like this in a really long time. Meanwhile, Carol Tomei has been really doing a fantastic job of making them a more efficient organization and doing business, high margin business. FedEx has been less good at that. FedEx has the upside or downside of having a big opportunity of margin improvement because they haven't been run as well as they could have been. And the valuation there at 10 times earnings, I feel like at 10 times earnings, it's hardly frothy, and a lot of sort of bad things are priced in. So I'm hanging on to both. I'm thinking about actually buying more UPS going into earnings. I don't know if it's a week or two from now.
Guy, how about the notion that you don't want to own these things when the Fed is hiking rates? True or false in your view?
Makes sense. I mean, Jim outlined it pretty well. I'll say this. J.B. Hunt is down about 24% from the all-time high back in March, number one. The level it just traded down to, this 167, 168 level, that was the low that we bounced from in October. You can make a decent case for J.B. Hunt on valuation. There's an intermodal play that I don't think they're getting the benefit of. By the way, if you look at the quarter, really strong numbers on that front, and it trades basically right now at a market multiple. So I totally get what Jim is saying, and there's absolutely no compelling reason to buy this stock. But I think for a trade against this 168 level on valuation with this earnings release, I think you can be long J.B. Hunt here.
Julie?
I think if you look at transportation overall, it's been under so much pressure initially. So you have spot rates that are below contracted rates. And so there's going to be pressure. But you know what I say? It's like not all stocks in a sector are the same, just like not all my boyfriends were the same. It depends. So there are definitely some quality names that you can own. A name that I would think of is a company called Old Dominion. And, they have proper network effects that structurally protect their business. And so they have been able to benefit, obviously, from a very strong supply chain environment. But I think even in a softer market, they can continue to do well. It's a durable business, and that's the type of quality we want.